An overview. As the author states, financial statements have the potential to either be a map that can help the users to reach their desired destination through clarity of representation, or a maze that attempts to confuse the user by purposefully introducing conflicting elements and complexities that prevent reaching the desired goal. As a map, the financial statements have the capability to form a very solid foundation from which the user can understand the financial position of the business and for assessing both its historical and prospective financial performance. Prepared properly, they can provide a clear representation of the firm's financial health, leading to informed business decisions. One way to think about this is to think of how a doctor uses an x-ray to see inside the patient's body to be able to diagnose the cause of their illness. If the patient isn't still when the x-ray is taken, the image may be blurred and the doctor may be unable to accurately determine the patient's condition. Financial statements are also like this. The more transparent the financial reporting, the easier it is for the user to accurately determine the strengths or weaknesses of the company. The distractions or noise that enters into financial reporting that can interfere with and hinder the user's ability to accurately assess the true condition of the business are many. First, there is an overwhelming amount of information that can be very intimidating to the average user. Second, auditors do not always provide audit opinions that clearly represent the fairness of the presentation of the company's finances. Failed audits have led to many lawsuits against auditors, such as the situation with Arthur Andersen and Enron. Third, as you already are aware, accounting policies and reporting requirements are getting more and more complex as businesses become more complex. This affects the quality of the information that is provided due to the ability of the company's management to pick and choose among various accounting rules and the amount of estimation that goes into accrual basis accounting. Last, there is so much information that is not available in the financial statements that it is critical and almost impossible to measure. Some of this information is considered to be proprietary by management, and they do not want it released lest their competitors get an advantage over their plans. So, the author has set as one of the main objectives of the book to help to ensure that students are able to use the financial statements as a map instead of a maze by learning how to read and evaluate financial statements. This course will provide tools and techniques that, when used properly, will allow you to complete a comprehensive financial statement analysis and encourage intelligent business decisions. Whether you become a financial analyst is not important. If you are an employee, you will have to make financial decisions with your retirement portfolio that will require you to understand financial statements. Even if you invest in a mutual fund with paid professional managers, you still want to be able to determine if they are making the proper decisions with your hard-earned savings. This is becoming even more critical to your generation as most of your retirement savings and investment decisions will depend on you. There is so much information contained in the financial statements that is very useful for making a variety of business decisions. First, you may want to determine the company's financial position. By this we mean, what are the firm's assets and liabilities? How do they invest the money they generate in the business? Do they have large amounts of cash and short-term investments, or invest in other long-term investments and property, plant, and equipment? How does the company obtain outside investments? Through long-term borrowing or through equity? These types of questions are important, as well as how successful the company is operating and the policies and strategies of the company for managing risk and opportunities. Although the financial statements are mostly providing historical financial information, they can provide information on how the company will perform in the future, and that is where they can be the most useful to investors. There is a large volume of information contained in the annual report, which is part of the 10-K, which is required to be filed by all large publicly traded companies annually with the SEC. The users of the financial statements will find within the annual report the financial statements, including the balance sheet, income statement, statement of stockholders' equity, and cash flows. Also, a large amount of information is found in the notes to the financial statements. The auditor's report that contains the audit opinion is also included, as well as other information that is required to be included by the SEC, such as a 5-year summary of key financial data, high and low stock prices, management's discussion and analysis, as well as other supplementary information that management may decide to include. The financial statements for U.S. companies are currently prepared using generally accepted accounting principles called GAAP, which have been adopted in order to achieve uniform reporting that is understandable and relevant and reliable for making decisions. The Securities and Exchange Commission, SEC, has statutory authority for setting accounting principles and is a public sector organization that is part of the federal government. However, the Financial Accounting Standards Board, FASB, which is a private sector organization, sets GAAP for U.S. companies. The International Accounting Standards Board, IASB, is responsible for establishing accounting standards for those countries which choose to adopt them, and these standards are called International Financial Reporting Standards, or IFRS. The European Union in 2005 began requiring publicly traded companies to use IFRS, and over 200 countries had adopted IFRS or a version of IFRS by 2009. This diagram explains the FASB-SEC relationship in regards to accounting policy setting. Congress gives the SEC the ability to set accounting rules, and in some cases the SEC does this through issuing rulings called accounting series releases, ASRs, and financial reporting rulings, FRRS. However, for the most part, the SEC allows the FASB to set accounting principles, which the FASB does through the issuance of accounting standards codification. The three primary goals of the FASB is to 1. Simplify user access by codifying in one source all authoritative GAAP in the U.S., 2. Ensure that the codified content accurately represents U.S. GAAP as of July 1, 2009, and 3. Creates a codification research system that is up to date for the release results of standard setting activity. The FASB released proposed accounting standards and accepts public comments before issuing the financial standards that then become GAAP. Sometimes there can be significant pressure on the FASB by reporting companies who do not like the proposed standards, such as occurred when accounting for stock-based compensation was issued. These companies will attempt to pressure Congress to prevent a very unpopular standard. Accounting scandals also lead to Congress imposing more standards like Sarbanes-Oxley when there have been corporate financial scandals that have caused tremendous investor losses. Because we now live in a global economy, there is a need to expand reporting worldwide, which we mentioned earlier in discussing the IASB and IFRS. At one time, it appeared that U.S. GAAP and IFRS would be converged into one set of standards that could be used by all companies in the world. However, the SEC stopped short of issuing a recommendation for this in July 2012. The reasons were varied, but some of the main ones they cited were the expense of transitioning to IFRS, insufficient influence over IASB standard setting, and the reliance in the U.S. legal environment on contract language that refers to U.S. GAAP. Many foreign companies use IFRS, and the SEC allows them to file their annual reports with them based on IFRS with no reconciliation to U.S. GAAP required. However, the SEC does not allow U.S. companies to use IFRS to report to them. This textbook will focus on the U.S. GAAP, but the analysis process can also be applied to reports based on IFRS. Differences between U.S. GAAP and IFRS will be discussed where appropriate. First, you need to learn how to find a company's financial statements. Each year, as we have stated previously, companies are required to file an annual report with the SEC called Form 10-K. It has a specific order to facilitate comparisons and data gathering on filing companies. The SEC developed a system called Electronic Data Gathering, Analysis, and Retrieval, EDGAR or EDGAR, that is used as the database for all of the filings of public companies. It can be accessed for free at the SEC website, www.sec.gov. Besides the 10-K, there are many other required forms that are filed with the SEC by public companies. Some of these are the 10-Q, which are the quarterly reports, and Form 8-K, which is used to report a variety of issues such as a change in a company's auditor, bankruptcy, or other special events that are required. It is also possible to find many public companies' 10-K on their own company websites, and some companies still provide shareholders with printed versions of the annual reports. Some of the information that is provided to the shareholders is in the form of promotional information that is used to generate goodwill and get more investments. One required form, the prospectus, is provided when the company wishes to sell to the public through a U.S. stock exchange either new issuances of debt or equity securities. Within the annual report, there will be the normal financial statements, notes, management discussion and analysis, and supplementary information, as well as information and pictures showing the company's operations. The required financial statements for the annual report include the following. First, a balance sheet or statement of financial position which shows the assets, liabilities, and stockholders' equity as of a particular date, such as the end of a quarter or a year. Two, an income or earnings statement that presents the results of operations, revenues, expenses, net profit or loss, and net profit or loss per share for the accounting period. Three, the statement of stockholders' equity, which reconciles the beginning and ending balances of all accounts that appear in the stockholders' equity section of the balance sheet. Some firms will prepare a statement of retained earnings that is frequently combined with the income statement and reconciles the beginning and ending retained earnings account. The companies that choose the latter format must provide the stockholders' equity statement in a footnote disclosure. 4. The statement of cash flows that provides information on the cash inflows and outflows from operating, financing, and investing activities during an accounting period. All of these statements will be illustrated, described, and discussed in detail in later chapters of the book. Immediately after the financial statements, there are numerous notes which are an integral part of the statement and must be read in order to understand the presentation on the face of each financial statement. The first note to the financial statements usually is a summary of the firm's accounting policies and contains information such as how the company determines its depreciation expense. There will also be disclosure on any changes in accounting policies during the reporting period and the impact of the changes on the current and previous reporting periods that are presented for comparative purposes. Other notes will cover important accounts such as inventory, property, plant, and equipment, investments, long-term debt, and equity. The notes will also provide detailed information on many topics including leasing arrangements, income taxes, contingencies, and commitments. Some companies must report additional supplementary information such as oil and gas reserves, effects of foreign currency translations, and segment reporting. This is the end of the presentation for Chapter 1, Part